The phrase housing market Armageddon has been tossed around with increasing frequency, in recent times striking fear into the hearts of homeowners, potential buyers, and investors alike. The concern is palpable. Are we on the brink of losing everything? To unpack this question, we need to delve into the complexities of the housing market, understand the indicators of a potential crash, and explore the possible outcomes. By examining historical precedents, current trends, and expert predictions, we can gain a clearer picture of what lies ahead. The housing market is influenced by a myriad of factors, including economic conditions, interest rates, government policies, and demographic trends. In 2008, the U.S. experienced a housing market collapse that had devastating effects, leading to the Great Recession. Home prices plummeted by nearly 30% from their peak, millions of Americans lost their homes, and the ripple effects were felt globally. Fast forward to today, and we are witnessing a different, albeit equally precarious, scenario. Post-2020, the market has been characterized by skyrocketing home prices, bidding wars, and a severe shortage of inventory. According to the National Association of Realtors, the median home price in the U.S. rose to a record $363,300 in June 2021, an increase of nearly 24% from the previous year. Such rapid appreciation raises concerns about sustainability and potential overvaluation. Several key indicators suggest that the housing market might be heading towards a correction or even a crash. As home prices soar, affordability becomes a major issue. The NAR's Housing Affordability Index showed that affordability dropped significantly, with many middle-class families priced out of the market. When people can't afford to buy, demand decreases, which can lead to a price correction. The Federal Reserve has signaled that interest rate hikes are on the horizon. Higher interest rates mean higher mortgage rates, which can dampen demand. A 1% increase in mortgage rates can reduce buying power by about 10%, according to Zillow. Despite government interventions, mortgage delinquencies have been rising. The Mortgage Bankers Association reported that as of the second quarter of 2021, 4.88% of all loans were delinquent. This is a troubling sign, as rising delinquencies can lead to foreclosures and an influx of distressed properties on the market. The housing supply remains constrained, with a shortage of new homes being built. However, if demand decreases due to affordability issues or economic downturns, the market could quickly become oversupplied, leading to a drop in prices. Looking back at previous housing market crashes can provide valuable insights. The 2008 crash was precipitated by risky lending practices, excessive speculation, and an eventual surge in foreclosures. The aftermath saw a significant loss of wealth for homeowners, with an estimated $7 trillion in home equity wiped out. Contrast this with the current situation. Lending standards have been stricter post-2008, reducing the risk of widespread defaults. However, the rapid price increases and low-interest environment have created new risks. The housing market is cyclic, and corrections are a natural part of the cycle. The critical question is the severity and impact of the next correction. In this scenario, the market experiences a mild correction where home prices stabilize or decline slightly. This could be triggered by gradual interest rate hikes and improved housing supply. The impact would be manageable, with a potential 5 to 10% drop in home prices. Homeowners might see a slight decrease in equity, but the broader economy remains stable. John and Sarah, who bought their home in 2018 for $300,000, might see its value dip to $270,000. While this is a significant amount, it doesn't lead to financial ruin. They continue making their mortgage payments and ride out the downturn. A more significant correction, akin to the early 1990s downturn, could see home prices dropping by 15 to 20%. This could result from a combination of higher interest rates, increased supply, and waning demand. The broader economy might experience a slowdown, but not a recession. Emily, who bought her home in 2019 for $400,000, might see its value fall to $320,000. This loss in equity is concerning, but manageable. Emily might decide to hold off on selling her home, waiting for the market to recover. In the worst-case scenario, the market crashes similarly to 2008, with prices dropping by 30% or more. This could be triggered by a severe economic downturn, leading to widespread job losses and foreclosures. The broader economy could enter a recession, exacerbating the housing market decline. Mike and Linda, who bought their home in 2020 for $500,000, might see its value plummet to $350,000. This $150,000 loss in equity could be devastating, especially if they face job losses or other financial hardships. They might struggle to keep up with mortgage payments, potentially facing foreclosure. One of the best ways to protect yourself against a housing market crash is to diversify your investments. Don't put all your financial eggs in one basket. Consider investing in stocks, bonds, and other assets to spread risk. An emergency fund is crucial for weathering financial storms. Aim to save at least 3 to 6 months' worth of living expenses. This can help cover mortgage payments and other essentials if you face a loss of income. Taking on too much debt can be risky, especially in a volatile market. Be cautious about borrowing against home equity or taking out large mortgages. Ensure you can comfortably afford your mortgage payments, even if interest rates rise. For potential buyers, renting might be a safer option until the market stabilizes. Renting allows you to avoid the risk of losing equity in a market downturn and provides flexibility to move if economic conditions worsen. Keep abreast of market trends and economic indicators. Understanding the broader economic context can help you make informed decisions about buying, selling, or holding onto property. The fear of losing everything in a housing market crash is understandable, especially given historical precedents and current market dynamics. However, by understanding the factors at play, preparing for potential outcomes, and making prudent financial decisions, you can mitigate the risks. While no one can predict the future with certainty, staying informed and proactive is your best defense against the uncertainties of the housing market. Whether we face a mild correction, a significant downturn, or a severe crash, being prepared can help you weather the storm and emerge with your financial stability intact. In the end, the question isn't just whether you will lose everything, but how you can best protect and preserve your financial well-being in the face of potential challenges. By taking steps now, you can ensure that you are as prepared as possible for whatever the housing market throws your way.